Howdy. Welcome back to Dion Talk. The income snowball is a concept that I've talked about in a few videos. I mentioned it in my BiggerPockets interview, and I realized recently that this is a concept that, like many things in real estate, can be as simple or as complicated as we want to make it seem. I was talking with some friends, and one of them tried to explain to me what they thought I meant when I say income snowball, and they really overthought it. And if this is your first time to my channel, it is my goal to teach the average person that it's possible for you to reach financial independence in 10 years or less, even if you're not starting from the best position. And I think the problem with my friend when it came to overthinking the income snowball was because they understood the debt snowball. I'm actually not a fan of Dave Ramsey. I think his first 3 steps are great and they work for pretty much everybody, but after that he pretty much loses me. I'm actually one of those investors that wishes I had more debt. And one of these days I'm going to make a video of my $1 million debt scream and send it to Ramsey Solutions and just see if they'll play it. But not today. But one concept that Dave Ramsey talks about a lot is the debt snowball. And this is a really cool concept. There's actually 2 main ways that people tackle debt. The first one is the debt snowball, and the second one is the debt avalanche. One makes sense mathematically, the other makes sense emotionally. If you're the kind of investor that likes optimization over everything else and has really strong discipline, then the avalanche method is probably the best way. This is where you take your highest interest debt, focus on paying it off first. If you're like me and you understand that you're human and emotions play a large part of your investing decisions, especially with me being so lazy, most of my decisions are based on what makes things easy for me. The debt snowball is where you take your smallest debt, don't look at the interest rates, focus on paying it off first, and then take that payment and the extra money that you threw towards it and work your way up in your debts going smallest to largest, because every time you focus and pay one off, you get a dopamine hit from the satisfaction from seeing that one debt disappear. Like I said, this doesn't make as much sense mathematically, but emotionally, this is the way most people are able to reach debt-free, or at least bad debt-free. And there's something that I've learned about investing. Learning how to invest or teaching somebody how to invest is very similar to my regular job. I run a truck driving school, and one of the hardest things about teaching somebody how to learn a new skill is when you're the instructor, trying to remember what it was like to not know something. And so when you know a skill or you understand a concept, it seems very simple, but when you try to explain it to somebody, it becomes very difficult. The idea for investing, for me, is really simple and comes in 3 phases. Earn what you can, spend less than that, make sure to save and invest the difference. The bigger that you can make the gap between what you make and what you spend, the more money you have to save and invest. That took what, 7 or 8 seconds for me to say? But I'm coming up on almost 90 videos, and I feel like I've just scratched the surface on all of the concepts in here that I want to put out there. And it seems like this is what's happening with the income snowball. When my friend was trying to explain to me what he thought I meant by that phrase was something like targeting your smallest investment amount and focusing on it, and then scaling up your attention to the investments as they grow in how much time or energy or money it's going to take to acquire that asset. I didn't understand exactly what he was saying, but that's a lot of overthinking. I am going to go into a little bit of detail on how the income snowball worked for me. But in its simplest terms, the definition of the income snowball, at least in my terms, is as you acquire cash flowing assets, the more of those assets you acquire, the easier and faster it becomes to acquire more assets. And I definitely don't want to start an argument between rich versus poor, because even when alux.com does their videos on rich versus poor, they get attacked in the comments. But there's a pretty simple concept of if you buy assets that produce money, you're going to get richer. And if you buy liabilities that cost you money, you're not. I'm not saying you can't have liabilities. What I try to help people understand is that it's okay to have a vacation, or buy a boat, or get the nicer car, or date somebody. But when you spend that money on a liability, I try to get people to understand that you want to buy an asset to pay for that liability, because once the liability is paid for, that asset is still yours and it continues to grow in value. Here's the breakdown of how the income snowball worked for me. I was starting from a position of some bad debt. I wasn't making a lot of money, and I had a pretty bad debt to income ratio. In the beginning, I wasn't able to save very much. And something that I've learned with conversations that I've had with people that I'm trying to help reach financial freedom is when I ask the question, how much can you save every month? Most people don't know. And running a business now, there's a concept that I've learned and I've implemented in almost everything that we do. Unless something is measured, it can't be improved. And a lot of times when I ask somebody how much they can save, when they don't know, they say not much or nothing. So I ask them, can you take $1 and put it in a drawer and not touch it? Just $1 a month. Most people say, yeah, they can do $1. Well, then it's not zero, it's not nothing, it's $1. And now that you have a number, you can improve it. If you can do one, maybe you can do $5 a month or $10 a month. It starts with something small and it grows into what you can actually handle. I had recently been laid off from a police department, and I started teaching people how to drive trucks at the truck driving school, only making $17 an hour. So when I decided to work on financial freedom, I chose rental properties as my path. My brother had reached financial freedom and retired before 50 with 10 paid off properties, and I thought that that was a path, something like what I wanted to do. But if you're an investor, you pretty quickly recognize the problems that I would have had at that point in time. I had bad debt, wasn't making a lot of money, so I had a bad debt to income ratio. And I had been working in law enforcement for several years and had gone back into truck driving, which meant I had changed the type of work that I did, and lenders like to have 2 years of the same type of employment to qualify you for loans. So my solution was to move from my house into an apartment and rent out the house. This did a couple of things. It let me test out the waters to see if I can handle being a landlord, single parent while working full-time. It allowed me to get rental income on my tax returns so that lenders would be okay with accepting rental income. They'll take 75% of rents into my debt to income ratio. And it gave me some time to show that I've worked at the truck driving school long enough for that work to be consistent to help qualify me for loans. So my first couple of years investing, I didn't really invest. I spent money on an apartment so that I could rent out the house. And there are 5 words that I think everybody should always relate to investing. It's a marathon, not a sprint. And yes, there's a contraction in there, so I kind of cheated a little. But it's those 5 words that make me remember that as I'm planning out years for investing, the end goal makes it worth it. It always confuses me a little bit when people talk about working 20 to 40 years for a pension, but looking at investing and they talk about a couple of years to wait for a return or a yield or to be set up to invest the way you want to as too much time. The first investment property that I purchased was this duplex because I'd had the same job long enough. I had had rental income on my tax returns. So my lender was able to qualify me to buy a duplex, which in my area costs about the same or a little less than what a single family house would cost. I reduced my living expenses from $1,500 a month for the apartment down to $300 a month for the duplex because the other side being rented out paid almost the whole mortgage. Being able to save $1,200 a month on housing expenses is a huge amount when you're not making a lot of money. It took me a little over 2 years to save the down payment for my next duplex purchase. But here's where the income snowball really starts to kick in. Most of us are familiar with how Einstein is quoted as saying, "Compound interest is the 8th wonder of the world." To me, the strongest thing that comes from investing in real estate is compound effects. In most of my videos, I focus on cash flow because that's the thing that gave me financial independence. I made work completely optional because my rental profit coming in every month is multiples of what my living expenses are. And I try not to focus too much on appreciation or principal pay down because those shouldn't be the determining factors as to whether we buy an investment or not. I think people should invest in things that have positive cash flow because if you're counting on appreciation, it might not be there. But that doesn't mean it's not a thing. Historically, over like the last 100 years, the average appreciation of homes across the board, even though there's like 400 markets in the United States, the average appreciation is 3.5 to 3.8%. And in 2020, because of a pandemic, most of us saw 15% or more appreciation. In addition to appreciation every month, part of your mortgage payment is called principal paydown. You actually pay down the actual balance of what you owe, increasing the gap of what the property's worth and what you owe on the mortgage. And as strong as these two elements of investing are, they're not actually factored in the income snowball. But here are some things that do impact the income snowball. Over time, rents increase, and the mortgages for the most part stay the same. Sometimes taxes or your insurance might go up a little bit in cost, but the principal and interest are already amortized all the way out through the length of your loan. In 2020, I refinanced 2 properties to a lower interest rate, and even with a tax increase, lowered my payment on each one of those properties over $250 a month, increasing my cash flow, which added to my income snowball. The reason we call it an income snowball is because when you roll a snowball down a hill, it starts to pick up momentum and it starts to run on its own and get bigger and faster without you having to apply a lot of effort. Getting the snowball started is where all of our energy goes. For me, at this point, I had cash flow from the house. I had reduced my living expenses by living in a duplex and house hacking. I added a duplex, which added to my cash flow. Between that first duplex and the second duplex was a little over 2 years. The next duplex happened in less than 2 years. And now, because of the cash flowing assets and the most important factor of getting the income snowball to work for you, avoiding life creep. I didn't spend money on more things, more liabilities. I kept investing the extra income into the next rental. If you think anybody can benefit from understanding the income snowball a little bit better, please share this video with them. If you think there's a Facebook group that you're in that would benefit from it, please post it there. But I want to take a second to just say thank you for every single comment you've ever made. Most of us understand how the YouTube algorithm works. The more likes we get, the more comments we get, the more likely YouTube is to share your content with somebody else. And don't get me wrong, I like it when there are a lot of likes on a video. It means that it was worth making. And I don't even mind the 2 X's that show up to every single video and hit the dislike button. I figure with as much as they don't like me, they probably should hit it twice. But the comments make me feel connected to you. I get to see the name of your channel and the picture that you chose to put there, and I feel like that is a person that's been impacted by the time and effort that I took to put this information into a video. And I really want to say thank you. I hope I've made your day just a little bit better. If you'd like to make mine a lot better, leave a comment. Until my next video, thanks for coming to my Dion Talk.
We're sorry, the number you have dialed is not in service at this time.